Hello, everyone. Welcome to another podcast episode. Thank you for joining me and thank you for the support on the previous podcasts. Today, another technology episode. And I know we've been doing a few of them and I promise we're going to move on. But there's been chatter in the market recently, especially since NVIDIA results, which we discussed last week, about whether we're in another bubble, especially relating to tech. And the question is so contentious that it makes sense to answer it, to give a bit of context and to understand it a little bit more. We've done so many episodes now around technology, the Magnificent Seven, NVIDIA specifically, the earlier episodes around Apple and Microsoft, that we have enough info available. We have enough of this built up knowledge to actually be able to answer the question. We don't have to sit and have a conversation for hours because we have the built up knowledge. So I want to answer the question, are we in a tech bubble? And there's no way to be conclusive about this. I'm not going to be able to give you the answer, but I'll be able to give you some talking points and some analysis points that I've used over a number of years to try and answer this question. My frustration with financial media, my frustration with analysts in our industry is that it becomes too easy to say if something has gone up 100% or 200% or 300%, that it is simply too expensive and that we're in some sort of bubble. Unfortunately, that sometimes isn't the case. The future can change dramatically enough that the prices that we see in the market and the change in prices over time could fairly and accurately reflect what these companies have experienced and what we will expect to experience. Said in a different way and in a better way, the change in prices might actually be linked to the change in the companies fundamentally, and therefore that change in price is valid. Okay. Now, in bubble world, and we'll get to what is a bubble, and I'll explain a couple of bubbles that have happened just now, including the last tech bubble, which happened in the early 2000s, 2001, 2002. You have to realize that the narrative is completely the opposite. A typical bubble is where prices of something, anything, increase dramatically that is not reflective of the world in front of us. And it is therefore incorrect, and those elevated prices should then come down at some point. That is a bubble which is opposite to a world where prices are reflective of the truth or the future. Okay. Narrative of the episode out of the way. Let's get our disclaimers done. This podcast is for informational and educational purposes. If you are willing or able or seeking to invest, please seek out the help of a financial advisor, especially if you're not a trained professional. In the context of this podcast, like I've always said, if I do refer to stocks, I may own them in a professional or a personal capacity. And for tech, that is true. Now, I told you that I sort of heard this narrative over the last couple of weeks post NVIDIA results that we've just rallied way too far. After NVIDIA results, the market went higher, NVIDIA itself went higher, and market participants therefore said that we've just gotten too excitable around NVIDIA. And that may very well be true, but we can't state it as fact without understanding the future around us. So let's start with the idea of bubbles. Now, I've told you what a bubble is when prices move way ahead of what something is actually worth. But just realize that around technology, this narrative of bubbles has been going on for a long time. We had the initial tech bubble in 2001, 2002. And since then, over the last 20 years or so, we've had a combination of technology companies do exceptionally well from a price perspective, your Amazons, your Apples, your Microsofts, etc. And I've been in the industry over that time, and every few years, it has come up that maybe these things are in a bubble. To put that in context for you, I wrote an article, and I have the date here, on the 15th of April, 2020. So in the midst of this COVID pandemic that we were experiencing, and the market sort of tanked in March and then rallied quite significantly into April, when a number of authorities stepped in and provided support to financial markets. And the tech bubble conversation happened then. And at that stage, I sat back and went, this is not like 2001 and 2002, which we'll get to. And because of that, we should think of this bubble or this environment for tech companies differently. These companies are different to what we were used to or what we saw in 2001, 2002. I don't want to toot my own horn because the future is uncertain. We don't know if we're going to continuously be correct. But since I wrote that article, the S&P 500, which is a pretty good proxy for US equities, is up about 80%. The NASDAQ, which also contains US equities, but has a higher weight to those technology companies, that's up 136%. So if you believed that tech companies or the equity market was in a bubble then and stayed out of the equity market, you missed a dramatic upswing in markets relating to tech companies and held up by tech companies. And I sit back and go, it wasn't luck that caused that to happen. It was fundamentals. To put in context, from a professional perspective, we were invested in tech through that period, out of that period, and into this new period where technology companies are running because of the AI theme. So if you're going to put out the case that we're in a bubble, you're typically going to associate that with not investing in that thing. Realize that if you're wrong, it is highly problematic. You're not going to sort of participate in continued performance of that sector. If something is actually in a bubble, it's just as important, because if you buy something that's dramatically expensive and it then had to fall, it's then losses that you're going to have in your portfolio or a client's portfolio. But the job of an analyst and the job of a portfolio manager is to really sit down and figure out and think about the future and whether these things make sense or not. In a few episodes now, and reels, shorts, TikToks, I've said over the last few weeks that investing in companies, investing in assets, investing in securities is all about the future. We are paying for future profits, and we're paying for those future profits today. So your vision of the future is going to directly impact how much you pay for something today. I've done that using the doctor's practice as an example. You can go back and find shorts and reels on that if you want to hear that example. But that is crucial. What is the future going to look like? And unfortunately, when you watch financial media, it's too easy for those participants to sit back and go, well, clearly this thing is expensive because the PE ratio is too high. We'll get back to PE ratios just now. But remember, a lot of those participants don't have skin in the game. A reporter in the financial media doesn't have an investment in Apple and doesn't necessarily care about an investment in Apple. But me, from a professional perspective, really needs to understand the outlook for some of these things so that I don't miss opportunities for clients, and at the same time don't invest in things that are actually bubbles in the context of clients. So the conversation is nuanced, it's important, it requires a thinking about the future, which is very difficult for people because the future is uncertain, it's unknown. But if you can put in the work and understand the environment at hand, you can earn significant investment returns by investing in areas that have the propensity to grow or that have levers for growth. And we bandy this word bubble around a lot, but we really need to ask ourselves, is this a bubble or not? And that's sort of part of the question we're going to try and answer today, and especially give context on what the bubble conversation looks like for tech companies today versus 2000 and 2001. And in 2020, when I wrote the article that talked about tech companies not being in a bubble and why this time was different. And you'll start to get an idea of where my brain has been going with technology. And you probably already have a sense of that if you've listened to any of the episodes around AI, the AI revolution, and the structural growth we've seen around AI. Now, I've said what a bubble is. It's when you pay a price for something that is not fair. You're overpaying for something. But not everything is a bubble. You know, if you I think Nando's, and this is a South African example, but UK participants or listeners will understand this. Nando's sells chicken. Think of it as, I don't know, a Wendy's in America. I think Nando's products, burgers, chicken, etc. is dramatically overpriced. Okay. Is Nando's or the menu items in Nando's in a bubble? No, because there's overpaying for something and then there's dramatically overpaying for something. Okay. When we talk about a bubble, we're talking about a world where something costs X and you're paying a dramatic price, 500x, 1000x, 10,000x for that same thing. So I don't think Nando's is good value for money, and I guess Nando's will never now be a primary sponsor on this podcast. But Nando's food is expensive in my view, but not so dramatically expensive that it's in a bubble. That's the important difference. Now, you might sit there and go, well, Nish, what is the level where something is in a bubble versus just being traditionally expensive? There's no number around that, unfortunately. I can't tell you that if something is 10,000x versus its share price or 1,000x versus its share price, it's in a bubble. So the definition is a little bit gray. But let me give you 3 examples of bubbles we've had in the last couple of 100 years. And you'll notice I'm saying a couple of 100 years because these things don't happen all the time. We're talking about a vast and dramatic overvaluation. And if you sort of understand the examples, you sort of get a sense of what I'm saying. And the last example is the dot-com bubble from the early 2000s. That's going to give us context and lead us into the conversation about current tech companies. Okay, so the 3 examples I have for you are the Dutch tulip mania example of a bubble, the housing crisis in 08-09, the global financial crisis, and the dot-com bubble from the early 2000s. Now, I just want to get the date for the tulip prices, or the Dutch tulip mania, just because I think that'll give some context too. Let me see. This was a long time ago. So it was the Dutch tulip mania crisis was from 1636 to 1637. So we're talking about hundreds of years ago, right? But the context around the crisis was, or the bubble was, that tulips were used from an aesthetic perspective to make outfits, hats, etc. just look fancier. That was its sole use. You know, you had a hat, you put a tulip on it. You were now an aristocrat, basically. You had a cool outfit, you put a bunch of tulips on it. All of a sudden, you were sort of flaunting something that not everyone could have. Tulips were not something that were common. They were not easily gettable. They often needed to be imported. And just like things like spices and stuff that came from the East, if it takes a lot of effort to bring something to you, it's typically going to be expensive to buy it. Okay, there was demand from wealthy people to show off their tulips on their outfits and things. So as you can see, and this is a demand and supply thing, an economics 101 thing, there was this demand from aristocrats. There was a limited supply because it was hard to get these things. And therefore, the price of these tulips went up. Quite simply. Okay. Now, remember, that is not a bubble. Okay. That's just simple demand supply. Prices can go up. It's my Nando's chicken example. How does it then become a bubble? Well, I'm going to call them traders, but they're not necessarily traders. They're more like speculators at this stage. Realize that there's a market for wealthy people buying tulips, that there is a limited supply of tulips. And if that's the case, then they expect tulip prices to increase. So what happens? The speculators come in, start to buy a bunch of tulips. Already reduced supply becomes even more reduced supply. The price of tulips start to go higher. And as these speculators start bidding with each other, expecting tulip prices to go even higher, the price of tulips absolutely skyrockets. Okay? And when I say skyrockets, I mean far surpassing anything you'd be willing to pay for tulips. But speculators kept buying them. Why? Because the expectation was that there would be this demand from aristocrats. But put in context the fact that tulips was just about making your outfit look better. There was no fundamental need for tulips. It didn't save your life. It didn't make your life dramatically better. So when prices reached some nirvana valuation, people buying tulips just stopped. And if you're sitting there with a bunch of tulips expecting the price to go up, and if you've paid this meteoric price expecting tulips to go even higher, you were left holding the bag effectively, and tulip prices absolutely crashed. So that bubble resulted in tulip prices going extremely high, way too high, and then a crash down back to some normal level where those who bought at the top absolutely lost a significant amount of value. That was the Dutch tulip mania. The second example, which is a great example and a much more recent example, is the housing crisis in 08-09. That one's also sort of easy to understand if you focus on the key elements, but it gets lost in so much financial jargon that people haven't understood it as well as they should have. Effectively, what was happening is that lending standards for homes were going lower. Why was that the case? Because banks effectively started getting lazy around loans. They started dishing out loans to people who really couldn't afford them, who were delinquent on prior loans, who couldn't afford to pay credit card debts or didn't have proper jobs and stable incomes. So they sort of gave out loans, too many loans to people who couldn't afford it. And if you give loans to people, they are going to buy homes. So too many people were buying too many homes, and housing prices went up. The banks didn't think that was a problem, lending to people who couldn't afford it, because the theory was housing prices always go up. That was the prevailing theory or knowledge at the time. And in that world, even if someone takes a loan for a home that they can't afford, if you claim that home back, you can effectively pay off the loan. Okay? So the rates that these people were paying were dramatically lower because all of these things were supposed to be super safe. Okay, what actually happened, especially with a type of loan called a subprime loan, is that a subprime loan generally sits at a higher interest rate, so it's already more expensive, but it has a sort of variable rate inside where you can go from paying a sort of 2.5% interest rate to all of a sudden a 5 or 10% interest rate from one year to another, right? There's like a lifting period. And when that happened, these people who were already in a precarious position around taking up these loans were absolutely taken out at the knees. They couldn't afford their homes anymore, so they had to sort of default on the loan. Banks thought that was fine, because they could then sell the house. But if it happens everywhere, housing prices, which is supposed to always go up, actually start to go down because the supply of houses goes up dramatically. There's just way too many houses, just like there were too many tulips and people weren't buying them anymore. So all of a sudden, this asset, housing, which is always supposed to go up, starts to go down for the first time. And that is the bubble. Housing prices just got too high because of very shady loan practices from a number of banks, particularly in the US. So those are the two very famous examples of bubbles, of prices going sort of dramatically higher than they should have. The dot-com bubble example, the third and final example from 2001, is probably the easiest example to understand because it's quite tangible for us in the modern day to understand. So we get into the early 2000s, and if you were alive and if you know what is happening since then, our listener base skews a bit younger, so you probably were quite young at the time. But going into the early 2000s, it was sort of the internet heyday. We were all starting to go online for the first time. We had emails for the first time. We were interacting with people online for the first time. And what happened was it caused significant euphoria around the future of technology, as it should be, right? For the first time, we can do things online. We can potentially buy stuff online. We can interact with people around the world in a new and almost immediate way. So what happened was a number of companies with a tech angle to them started to list themselves on financial exchanges and raise money via stock issuances, issuing shares. Their share prices started to list and they went up dramatically high. Why? Because investors in the market, whether they be investors like you and I, professional investors like myself at work, sat back and went, well, these tech companies are going to absolutely change the world, right? The world is going to look completely different 10, 20 years from now. And what happened was the prices of those things went dramatically higher because we thought that they would effectively change the world within the next year or two. Now, clearly that wasn't the case. Every single tech company at that phase was not going to do well. More than that, the technology revolution wasn't going to appear in the next year or two. It would literally take 10 or 20 years for it to reach its sort of zenith. It's probably where we are now, to be fair. And as we know now, there are a few very significant winners, the Magnificent Seven companies, but not every company was a winner. And take my word for it, back in those days, you had a number of companies that just had a .com moniker to it, like pets.com or food.com or whatever it may be, that listed, had significant share price increases because investors thought they would just absolutely do well. Now, what's crucially important about those companies in that .com era was they were virtually brand new companies, most of them, and they didn't even sell anything yet, let alone earn a positive profit. Okay, these companies were betting on the future of the internet. So the price that you were paying for these companies was all about the future, not today. And that is a key distinction between the technology companies we have today versus the technology companies we had in the .com bubble. When you take something like Apple or Nvidia or Microsoft or Tesla, all proverbial tech companies. When you're buying them today, you're actually buying quite a mature technology company that has a demonstrated stream of sales and revenue, a demonstrated stream of positive net profit and significant positive net profits, significant balance sheets in the sense that they have a bunch of assets. They're often sitting on a ton of cash to protect themselves if markets had to change, if there was some regulatory burden on them, if they needed to just shore up themselves in a time of crisis. That wasn't the case in 2001. Those companies had very limited reserves of cash. Their balance sheets were very weak. They relied on raising capital in financial markets on valuations that they didn't really deserve. And you have to put that distinction on the table, because if you say it's a dot-com bubble today, you're saying companies like Apple and Nvidia and things are sort of dramatically overvalued and don't actually deserve the rating that they do. But a number of them are extremely high quality from a number of different perspectives and deserve at least some of the rating that they have. These companies are very different to the dot-com bubble companies we saw earlier. And that is my point of departure from traditional media. When they put these two things next to each other, there is this assumption that these companies are exactly the same, the dot-com bubble companies versus the tech companies of today. And that can't be further from the truth. We have moved on a lot. Having said that, things can get too expensive, right? As much as companies like Apple are great companies, I have spoken in my podcast episode about how I'm worried about iPhone growth. And just like any period where we can pay too much for something, like the proverbial chicken burger example, prices can go above a fair value. And if they are above a fair value and that value is not warranted, then we need to sit back and think, hey, should we now be selling these companies because they're too expensive, right? Or in the extreme example, are these now bubble companies? Okay. Now, I'd love to teach you how to value a company, but it's hard to do in a podcast. It's hard to do in an audio podcast, let alone the YouTube video, which is also going to go out for this episode. But as we go along through these episodes, I will introduce you to different valuation techniques in bite-sized chunks. For this episode, I want to introduce you to something called the price to earnings ratio for a company. Now, if you're a student in finance, if you're a professional in finance, even if you're a retail investor, you've probably seen this in financial media on an app somewhere. The price to earnings ratio is the price you're paying for a company, the share price, divided by whatever the earnings was for that company over the last year. Okay? So if a company is earning $1 per share, right, for the year, and if you're paying $20 for that company, in terms of that's the listed share price, then the PE ratio clearly is 20 times, 20 divided by 1. What does that mean in terms of the narrative of the PE ratio? 20 divided by 1, 20 times, you're paying for 20 years of future earnings today, right? You're paying $20 per share for something that earns $1 per share. Said differently, you're paying for 20 years worth of earnings. The bigger that number goes, or said differently, the bigger the price of a company goes, the more years of earnings you're paying for. So if you're paying for a 35 PE company, if you're buying a 35 PE company, you're paying for 35 years of future earnings. If you buy a 2 PE company, you're paying for 2 years of earnings. Now, you might think that you don't want to pay for any years of earnings. You want to buy a company with a PE ratio of 1. You know, buy a company that has a 1 PE ratio, 1 year of earnings is equal to $1 in price. That might seem fair to you. But remember, you buy companies for the future, not the past. So you're always paying for future earnings. The question is, how many years of future earnings are you paying for? And when I say it like that, a lot of financial media people go, well, the PE ratio for Nvidia is 70. That is what the number is right now. So you're paying for 70 years of earnings. And how can you pay for 70 years of earnings? The 20-year average for the S&P 500 is about 20. So how can you even validate paying 72 PE for Nvidia? That idea, that narrative around a PE ratio is not correctly reflecting the dynamic. Why? Because when we talk like that, we're only talking about the price part of the formula. Remember, it's price divided by earnings, okay? So when you pay that 35p, you're just thinking about the price, but you're not thinking about earnings. Why is the earnings part important? Because if Nvidia, thanks to the AI theme, continues to grow dramatically, right? What happens to its earnings every single year? It goes up. I have the numbers. And if you're watching this on YouTube and you see my eyes flitting around, I'm just sort of looking at the numbers on Bloomberg quickly. So I just want to quote you these numbers, right? So in 2021, in terms of revenue, so this is sales, the first line item for the income statement, Nvidia earned $16 billion in that year, and just in terms of sales, right? From that sales, its profit after expenses, after taxes, was $5 billion. Okay? $16 billion revenue, $5 billion of profit. That profit number is a number we're going to put into the denominator of our PE ratio. Okay? That number's grown because of the AI theme. And Nvidia sold a number of GPUs to a number of different companies, including companies in the Magnificent Seven. And its revenue as at today, so that's the 28th of January 2024, now sits at $61 billion. We've gone from a company that sells $16 billion or $16.5 billion worth of GPUs to a company that now sells $61 billion worth of GPUs. Its profit in that time has gone from $5 billion to $30 billion. Why is that so important? Because let's assume I'm paying 100 PE for Nvidia, right? In year one. So that's me paying for 100 years of Nvidia's earnings. Okay. If in year two, Nvidia is able to double its earnings, right? And we're paying exactly the same price. Let's assume price here stays the same, right? If they double their earnings in year two, what happens to my PE ratio? It goes from 100 to 50. Why? Because in year one, my PE ratio was, I'm paying $100 for a share that's earning $1. Okay. In year two, I'm still paying $100 for the share. It's now earning $2 per share. 100 divided by 2 is now 50. And that is crucially important. Now, so I've quoted you the numbers around Nvidia's earnings increasing from 5 billion to 30 billion, right? This is what it's done to its PE ratio. Nvidia's PE ratio was around it was around 36 times, okay? In the sort of 2021-2022 period, okay? That's relatively close to the S&P 500 long-term average. The PE ratio for Nvidia then goes up to 200, okay? Because earnings it was growing, but it was sort of still relatively benign, the growth. But the market vastly increased the price of Nvidia. Why? Because it started seeing this AI theme and realized that Nvidia would be a beneficiary of it and sell way more GPUs. The market took a view on the future of Nvidia. So the PE ratio went to 200 because earnings hadn't really changed. And the market was saying future earnings are going to change. I'm willing to pay a price of 200. What is Nvidia's PE ratio today? And remember, prices for Nvidia have gone up dramatically still since 2022. The PE ratio sits at 72. It's gone down from 200 to about 72. Why is that the case? Because earnings are increasing dramatically. So when people quote a PE ratio, they're very quick to talk about the P part, the price part. How much are you paying for future earnings? But they often forget the E. The E is way more important. How much earnings do we expect from these companies in the next 2, 3, 4 years? And for companies like AT&T or Colgate-Palmolive or Procter & Gamble, companies that have very steady growth because they're mature and we kind of know how many nappies people are going to buy, and in this world it's not really growing by that dramatic amount. The PE ratios for those companies stay quite stable. I talked about this last week and I made a couple of short videos on it, which you can find on social media, about cyclical versus non-cyclical companies. Okay, Nvidia is now in this growth phase where earnings can go up dramatically thanks to people spending a lot of capital trying to build up their reserve of artificial intelligence and this arms race around artificial intelligence. And that is why the earnings for Nvidia can go up dramatically still. And why a 72 PE ratio doesn't mean we're in a bubble still if the earnings can grow. That's how you link valuation to your story for a company. I can't sit here and just say that Nvidia's share price has gone up 6 or 7x, which it has, 6 or 7 times. Okay, I have to link it back to earnings. And the PE ratio helps us to do that. But people often use the PE ratio incorrectly by focusing on the price and not focusing on the earnings. And remember, we have to think about future earnings in the context of this conversation. It's a crucial part of the conversation. So if we sort of bring it all back, are we in a bubble currently with technology companies? Today's technology companies? Is this the dot-com bubble? Again, no. For me, and that's twofold. One, these companies exist today earning significant profits, helping people every single day. It's not simply the promise of what they will do. They actually help our lives and therefore earn significant profits in 2024. That is part of the valuation. Just by that alone, dot-com bubble companies are different from the companies we have today. The technology companies we have today, especially the large ones like the Magnificent Seven companies, are way better than the company in the dot-com era and can't be compared to dot-com bubble companies. From a second perspective, the growth that we are seeing in earnings from these companies is highly tangible, linked to this theme of AI and the AI growth. We have already seen some of that tangible growth just if you just listen to the numbers I quoted for NVIDIA. Whereas in the dot-com bubble period, we lived on a prayer that these things were going to happen, and they never did. Okay, we have already seen earnings growth related to AI. Can it continue to infinity? Can it go on and be even stronger? Yes or no? Okay, but then we're in the realm of, is something expensive versus a bubble? So to end off, when you hear the word bubble in financial media, it's often just this tantalizing little tidbit to draw you into the article. But as participants in financial markets, or as people trying to learn about financial markets, we have to delve one level deeper in our understanding, because it's not as simple as a reporter wants you to think. Hopefully this podcast has given you context around bubbles in general. You now know about a couple of bubbles. We've introduced the PE ratio, and we'll take valuation a step further. And you have now some sense of how all our conversation around technology have led us to a point where we can have an opinion on whether technology is in a bubble or not versus prior bubbles. In the next couple of episodes, I want to sort of go in the direction of putting technology in the context of equity markets to show you how big they are and why we've talked about them so much. And also to sort of put in context what other companies are out there that are important. Like, I really want to talk about the rise of these weight loss drugs that have become so popular from Eli Lilly and Novo Nordisk. So that will come in the next couple of episodes. If you've got to this far, as always, thank you. Me rambling on for 30 or 35 minutes is painful for people in my life. So the fact that you voluntarily have done this, I am thankful, and I hope you got something out of it. Well, you might be listening to this in podcast form. You might be watching this on YouTube. However you're watching this, thank you for doing that. If you can comment if it's on YouTube, or if you want to message us directly on Instagram, go ahead and do that. I try and respond to as many of those as possible. As always, stay safe, take care, and we'll see you in the next episode.